All right, folks, welcome back to the Pivot Podcast. I am joined with my amazing co-host, Mr. Dan Jansen, and we are here to bring you another riveting episode once again. Dan, I am so glad you could join me. How are you doing, and what are we going to be talking about today?
Great to be alive. Great to be alive, Tracy Ball. Always a pleasure to be back on the Pivot Podcast and get to hang out in the All Access Pass of Real Life Trading, recording this. So we get all these beautiful, smart, intelligent, I can't even think of any more adjectives, but you know who you are in the chat pane with us, asking questions as we record this thing live. But we got to talk about risk, Tracy. We want to talk about risk today.
More importantly, we're going to be talking about position sizing.
Well, explain to me, how does position sizing, what is that, and how does it pertain to risk?
All right. So first of all, there's a few types. So two types of position sizing. So you can actually get into actually a risk where you control your position based on the amount of risk that you want to apply to each trade, or the amount of money that you want to spend getting into the trade. So there's two types of real risk control that we can talk about. And we can discuss, first of all, I guess, what's the difference between the two. So when you're looking at risk per trade, that's a set amount that you're willing to risk per trade. And what that means is if it hits the stop, that's what you're going to be exited out at. And that's the max you can lose, versus a spend trade where you say, I'm going to get into a trade. I'm going to spend $30,000 on every single trade that you get into. Maybe it's $5,000, but you allot a specific amount of money to get into certain trades. And there's different ways that you can manage your risk for each of those. Now, one of the questions that I have for you, Dan, is the difference between consistency and inconsistency. So what would be the difference? Let's say that you decided to trade 1,000 shares every single time you got into a trade, and that was your maximum amount of like, you just bought 1,000 shares every time you entered a trade. What could be the downfalls of doing something like that versus considering the risk per trade and positioning your size that way? What do you think would be some of the risks?
Yeah, it's very different. So obviously the asset that you're trading is going to matter a lot. If you're trading 1,000 shares of Snapchat and you're trading 1,000 shares of Tesla, you have a lot more risk. I mean, if you have 1,000 shares of Tesla that moves 1% in a day to the negative side, you're losing a heck of a lot more if you have 1,000 shares of Snapchat and it starts dropping on you. So it just, and not only that, but obviously anything with the bigger price tag, Nvidia, you have Apple, you have, like I said, Tesla, a bunch of the bigger guys. I mean, they could easily move 50 cents, 75 cents before really making its move that you're expecting. Where maybe 75 cents on a Snapchat or a Delta or something like that is going to be a lot harder to get a type of move like that. So,
right.
And this is my issue with a lot of the YouTube people that are trying to trade live and stuff like that. Some of them might be great traders. Some of them might make as much money as they claim that they made. The problem is, and maybe they even have great setups and all that stuff is true. The one biggest issue is they don't talk to you ever about the positioning of how you should position yourself, right? You are not guy XYZ on the internet that's been doing this forever and has extra revenue coming in from YouTube ads and everything else. You're not in the same position, right? So if you're sitting there with a $25,000 account, you're just trying to surpass PDT, and that guy's got $1 million in the account, him taking 1,000 shares of something is a lot different than you taking 1,000 shares in the same type of trade or account. The other thing I would say too is a lot of these guys that are scalping, when it comes to position sizing, they tend to have an idea. It might not be as we might calculate it to, okay, here's my entry, here's my stop. I need 643 shares. They might know, okay, I'm going to do 650 shares. They're comfortable with the loss, but they know their spread is $1 on it. So they have a rough idea in their head. That doesn't ever translate over to somebody else just kind of playing along. Or they have that built-in mechanism where they see the P&L get to a specific number. So for instance, they set their risk at say $500. And if the trade starts to turn against them, they can actually mark it out at that $500. They don't know exactly where that stop might be necessarily. They just know that
hey, I'm getting in this many shares, or I'm scaling into this many shares. The expectation is the move is going to go up to this point and I'm going to exit immediately. But if it turns around, I'm going to exercise that muscle and just mark it out. Now, why is that not a good practice for most traders? Why is it important to more use hard stops for you instead of just watching that P&L change and then just randomly throwing in your position size and not managing it with a stop?
Yeah, that's a good question. I would say there's a few reasons as to why.
Okay.
One is the person that's been doing it longer, that is comfortable with it. He or she has probably been like, they're pretty consistent as far as what they do, and they know, okay, it's $500 loss. I'm just going to mark it out.
Mm-hmm.
A lot of times for, number one, new traders, and then I would say even some experienced traders that are looking for the setup, and okay, I'm down 500 on the trade, but this is probably also the bouncing spot, or this is where we could get some kind of, and all of a sudden you're not stopping out. Now all of a sudden you're down 750. You're like, okay, when it bounces back to 500, then I'll just get out.
Mm-hmm.
Now you're down 1,000. Now you're down 1,500. And one trade, because you're now relying on emotions and the ability to do it. Some people have it built into their human DNA, and some don't. I would say, regardless of, you're trying to get into the stock market and win money, right? You're trying to make money from the stock market. Well, if you're down, that's going to, the same thought process that you might have had getting into the trade is going to be very different. And now the way that you were thinking before, and clear-headed space that you were before, is probably a lot shadier and a lot different to control. So having the hard stops, and how do you feel about getting wicked on those type of trades with the hard stop? Because that's going to be the one line of defense that people have of like why they don't use stops.
Well, I can tell you, as a new trader, when you get wicked out, the immediate reaction is, oh, that damn stop, right? The stop got me. I shouldn't use stops. That's the immediate reaction of a new trader. The more seasoned trader, or as you're getting more into the intermediate side, you should be actually looking at that wick going, what can I learn from that? And how can I adjust my stop placement a little bit better so that I don't get trapped like that? Because that's really what it is. It's a liquidity find, and you're getting trapped in that liquidity. So you're placing your stop in a very optimal place that everybody else is putting it, and that might not be the best thing for you. So there's a few things that you can switch that mindset. And when you get wicked out, you're either getting mad at the stop and then doing the thing that you shouldn't be doing, which is saying, I'm not going to use stops anymore, or you learn from it and improve your stop placement and improve your trade management. So when I get wicked out, it doesn't feel good. I made a mistake. There's something that I need to learn from that. So that's the way that I look at it at this point in my career. So how about you?
I look at it as a sentiment thing.
Okay.
I go, all right, so I had a mentorship group with one of the members last night. We were kind of looking at pre-timed, like good spots for a meta trade, and we're like, okay, we'll take it short. If it runs up a little bit, maybe we get filled. This we think is a good stop. It was above a huge wick, so we ended up getting in today. Sure enough, we get filled. Keeps on running. Eventually, we get stopped. Right now, if I look at it, if we didn't have stops, we'd be pretty profitable on the trade. But the one question that came up during that he asked is, well, what if they come up and just take the wiki out? And I'm like, okay, my thought process was, this is a bearish trade, right? I think we come down, it shouldn't get here. And if my thought process is bearish and those bulls are able to carry it up past that wick, even if it's a trap or not, really at that case, how strong is the bears on that play, right? The bears were not able to defend that spot. They were not, it's a spot it shouldn't have got to in the first place.
Yeah.
If they want to come up and wick me and I lose the R, great. Okay, we went back, we made more than we lost on another trade, back to positive, and some more trades. We're doing great for the day. It's not the end of the world if you get stopped. It's not the end of the world if you get wicked out. It sucks, but you know what? Okay, there's always another spot you could get back in. You could try it again. There's other stocks out there.
That's the thing.
But to me, the sentiment has changed, right? You're like, well, how strong was my direction on this trade if they did manage to get back up? So I don't really get too fussy about getting wicked out. It's going to happen.
Right. Well, and the other thing to consider, because the sentiment is definitely there, is the timing issue too. So the sentiment may have been there and it might be correct, and even the analysis might be correct, but your timing's not quite right as well. So if you go back and even analyze your stop, either the trade didn't work and you didn't want to be in it because the sentiment wasn't as strong as you thought it was going to be, or your timing was off and you needed to just wait a little bit more, be a little bit more patient, or that particular trade just didn't work altogether and you're looking for another opportunity. So it's just change your perspective. Remember, it's not the stop's fault. It's really in your own decision making that you need to adjust and change and fix. Stopping the stops isn't the problem. So anyway, but the position size, when you are choosing to go with just a set amount of stock, so let's say 1 lot, 2 lot, 3 lot, whatever, that might work for a lot of scalpers, like I said, who are just, as the position is working for them, they'll just keep tagging in with like 100 shares or 100 shares and building that position up as it's working for them. They don't really sit and calculate an entry and a stop and then figure out their position size, as said, but they have some kind of a stop, a number in their head that when it starts to go against them, they get out. Then you have the risk parameters where you actually calculate your risk, decide your position size, and then get in. What I'm curious though is, why is it important to keep that consistent? What are the reasons for keeping that consistent? So in one trade, I lose $500. The next trade, I lose $1,000. The next trade, I lose $30. The next trade, whatever, that kind of inconsistency. Why is it important to keep the risk the same? So if every trade you lose, the max you lose is say $500 or say $300, whatever your R is set at. What can you say to that?
I would say that the majority of people who make their way or find themselves journeying into the stock market, their thought process is, how much can I make in the stock market? When the real question should be, how can I be consistently profitable in stock market? Because you could have a great win, right? And you can make money on a certain trade, and it happens all the time. We just have a massive runner and it's terrific, right? We don't have crystal balls. We don't know which trade that's going to be. All we're doing is playing the probability of, I mean, if you look at the basics of it, you're a 50% trader, 50% chance of being correct regardless. And all we're trying to do is increase that probability by certain setups, sentiment, candle, volume, etc. So we're trying to increase the probability, but at the same time, it's still a 50-50 coin flip at the end of the day. The market's going to do what the market wants to do, right? And you have no control over that. All you have control over is your setup. So if you are losing on $1,000 trade, but you're at a $500, okay. Now you need 2 really good trades to really make up for that, and the math is not on your side, right? So you want the math to be, I want to be the worst possible trade. I want to have the worst record out of every trader I've ever met, but still be positive at the end of the year. And if I could do that, okay, all I have to do is improve my trading at that point, right? I have to figure out better setups. I have to try to work on the screen time. There's a lot that I could do on the back end to improve that. But I don't want the odds to be shifted against me where I need more wins than I need losses.
You're absolutely right. And each strategy that we work with, every strategy that anyone works with, has some form of probability that's attached to it. It could be 50% successful. It could be 60% successful. It could be 70, 30, whatever it might be that is successful. But the minute that you change one of those variables, you've altered those odds, just like you're saying. So I love that. That's exactly it. And that's why it's important to keep it consistent. But position sizing is one of the number one reasons why people lose in the stock market. They're over leveraging themselves. Let's talk about position sizing, going from a day trade to a swing trade. How does that affect your potential trade and your risk?
I would say, I can answer that a couple ways. One, I would say it could be the same. So you could have the same risk unit for a swing trade as opposed to a day trade. And I could also, on the other hand, say that it could be different, but that's all predetermined. So, for instance, I'm a big proponent of having multiple accounts, having an account just for day trades, having an account just for swing trades, right? And maybe they're different sizes, right? Maybe your day trade's a lot bigger than your swing trade, maybe vice versa, and you want to base your R off of that account. Right? Your R size, your risk unit could be different, right? I have no issues with that. But as long as it's consistent in that account. So if your day trading one is $500 R and your swing trade's 1,000, because, all right, I'm going to be in the trade a lot longer. Maybe I want to get paid a little bit more for that, but my account size could also handle it. I'm perfectly fine with that. As long as you're consistent, because it's about the number of trades, the number of setups, and winning more than you lose on those trades.
Right.
And I would say if you must have everything in one account, then I would have my R exactly the same. I would not change the R because it should be based off your account size. And whether it takes 2 weeks to hit that aura on a swing trade, or it takes 12 minutes on a day trade, that's a mute point. That should be, your account is your account, and that your R should be based off that.
Right. I'm thinking more, well, at least when I go from swing trade or day trades to a swing trade, there's one thing that I need to consider, because your position can be very.
Are you talking about opening a day trade and then just keeping
it
into a?
Yeah.
Oh, okay,
for individuals that actually go and they'll be in a day trade and they decide, you know what, I want to turn this into a swing trade, which for the most part, I don't think is a good idea, but there are certain circumstances when I think it's okay. And position sizing is the biggest problem for most traders when they do this. So they're highly leveraged when they're inside of a day trade. And then when you go to move into a swing trade or convert it to a swing trade, that leverage carries over unless you make some adjustments. So one of the things that I always consider is stop placement. So your stop placement in a day trade is going to be different than your stop placement in a swing trade. Or maybe it won't be. It depends on how good of a day trade entry you get. So the first thing that I'm going to do if I am going to be converting my day trade into a swing trade is I need to zip over to that daily time frame or the hourly time frame, whatever the swing time frame that I'm using. And I have to see, where would I want my stop right now if I was in a swing trade? And then from there, if my day trade stop is in that location, then I can continue to trade. I can continue to convert that into a swing trade. Or I then have to make some mathematical calculations. I'll move my stop to where it needs to be, recalculate the position based on where my entry is. And if I have to scale out some before the end of the day to carry the rest of it into the next or into the overnight, then I can do that. But at least I've positioned myself accordingly. Most people look and go, I'm in this day trade. I'm just going to either wait to see what happens overnight and see if I can get back some of my losses, or give it a little bit of time, but they're not considering how much it can move overnight during that time. And like I said, jump over that stop. So you might still have a stop in place, but the risk of that stop getting skipped, missed, jumped over, hit, whatever it might be, and extending that 1 hour loss to a 2 or 3 or 4 hour loss is significantly higher. And it all comes down to position sizing.
We just saw the same thing on Square today, right? Square had a massive gap down from today time of recording. Hindenburg report came out. It wasn't even last night. It was this morning about, I don't know, an hour before the market opened. Yeah, it just came out. Bad news on the company. If you were a person who if the gap works in your favor, congratulations, you made a lot of money, right? But at the very same time, if you probably had on Square maybe $1 stop on a day trade, that stop to your entry, if you're positioning yourself correctly, should be a decent amount of shares. You are a little bit more leveraged because you're expecting to get in and out. Mm-hmm. And then so what happens if that stop, let's say you don't get stopped, you don't get your target, and you go, okay, I think it's still I still like the momentum of it. I still like everything. You come up with 1,000 reasons, right? But as soon as that one random report comes out, that news piece comes out, and Square drops 20% in one day, that's one heck of a lot of R's and you could have had a great trading month up until today. That one trade could wipe your entire month out. Right. Yeah. So what I typically tell people is you have to, like you said, it's not usually typically if I'm getting into something as a day trade, then realistically, okay, I'm fine with, just being out. And if it doesn't hit either target, I'll sell and I'm good. That's it. Tomorrow's a new day. I'll wake up and try something else. But if you're like, I really like this trade, I like the momentum, everything is good, you have to adjust your stop. So maybe you do have 1,000 shares of Square or Tesla or whatever the case, right? What I do is I now go, all right, well, I took the trade, my entry, my stop was on a 3-minute chart, a 5-minute chart. I'll look at the daily chart and I'll say, if I want to get into this thing as a swing, where would my entry be? Where would my stop be? Right. And now I just reset it. How many shares do I need? Great. Yeah. Sell the rest. Doesn't matter if it's a loss or win. But now my stops are more realistic based on that time frame, and then it's kind of converted over to a swing. So, like you said, use that calculator to take some, carry the one here and there, and set yourself up correctly where your stop is a reasonable spot. You can still get those gaps and wild moves, but that's with any swing trade. But you're not at risk as much.
Well, and I bring it up because there are a lot of times where I will enter into a day trade specifically because I was planning on entering into a swing. And the idea is to actually improve my entry point. That's kind of So I've got a stock that I'm looking at getting in, and I would much rather get in at a better price. So I will look at it on a daily time or an intraday time frame and try and improve that entry. And depending on how it performs throughout the day, I will either exit the position at the end of the day or I will continue. So if, for example, I was planning on a trade, got in at a really good entry, and at the end of the day, the entry is above where my swing would normally enter into, then I will keep that trade and I will hold it. And congratulations on me, because I just ended up getting into a better position. I still have to make sure that my position size is the same as if I had gotten into the swing. So I will have to scale out a little bit, but that's one of the things that I'm looking at. The other scenario is, let's say that I get into the day trade, I get a really good entry, but it gets up towards where that swing would have triggered. Maybe it triggers, but then it closes really poorly. It fails, it gets rejected at that level. I'm going to exit that trade and I'll wait till the next day and see what happens. And I'll set the swing up again. And I might set it up again on an hourly or a daily time frame, or I might try and get into it on another daily time frame. So that's why I do bring it up, because I think it was James Dalton that said that every swing trader is a day trader when they enter. So that's kind of the reality. Now, not everybody might look at it that way, and not everybody might actually jump into an intraday chart to do it, but every swing trader is a day trader on the day that they enter. And that's just the way it goes. So, yeah. Now let's just change gears a little bit and let's switch over to the spend trade and talk about position sizing for that. So, when you do a spend trade, that means you're actually allotting a specific amount of dollars that you want to put into trade. What are your thoughts about throwing all your eggs in one basket and just saying, here's the whole account. Let's just get in as much as I can buy. What are your thoughts on that?
The sensible me says bad idea. the regular me says I can see it. I don't love the idea, but I would not, like, Rock says YOLO. Yeah. I would not YOLO in at one price, and this is the stock I love, and here's the play.
Right.
I can make a case where, okay, if you're going to pyramid into something, have those different levels, have a planned out, methodical reason as to why you're getting in and what prices, and don't. I've seen. So if anybody wants to search YouTube for real life trading pyramid, you can probably put in Matt DeLong. It should come up where he goes through an in-depth analysis. But even that, he's still taking 5 stocks, right? So if he has a $100,000 account, he's allotting $20,000 to each position, right? That makes a little bit more sense. The one thing I would say, but smaller account, you want to take that one stock, make sure that your levels are far apart, right? So he'll go through having 4 different levels as to where you put your entries. But and then I've talked to traders after, and they're like, oh, I have Tesla, my entries at 273, and then 272, and 271, 270. I'm like, that could all be filled in an hour, right? That could be filled in 5 minutes.
Yeah.
If you're going to give yourself some room on that trade, the entire point is you really want a dollar cost your average. So give yourself wider levels as to where you're getting in, right? And then if you're building up the position, great. Or number one, know how to protect the position. Mm-hmm. And then also 2 is make sure you do protect the position, because you don't want bad news on Tesla to come out and then your eggs are all in, you have no protection on it, and now you're just clearly underwater. So if you're going to, make sure you know how to use puts, make sure you know how to really work yourself around the position. Otherwise, typically I say stay away. Don't put everything into one place, and definitely not all at one location.
Right. See, and I will, but under certain circumstances. So for instance, I love buy and SPY. Love it in my long-term accounts. So some of it has to do with how long you're going to hold it, what you're going to hold, the stability of what you're going to hold, that type of thing. So for me, that's about the only time that I would consider if the SPY gap down tomorrow, or not gap down, but if it dropped 90%, whatever it might be, I probably just load up and see what happens, because I've got the time frame to do it, because I like the SPY. It encompasses a bunch of different companies. They'll adjust the companies as they perform well or perform poorly. It'll get rebalanced. So I don't have a problem doing it that way. But for other trades, yeah, it's exactly what you said. I'm going to either know my risk by dollar cost averaging and seeing, where my one risk unit would be that I'm willing to risk on that trade, or I'm just going to allot a specific percentage of my account for a spend. So for instance, we've all heard of the Momo indicator or the Momo strategy within real life trading. And that's really a buy sell signal. You buy when you see the signal to say it says buy, and you sell when it says sell, and you're putting in a specific amount every single time. So you're, maybe it's $5,000. You're getting in $5,000, and when the sell signal, you're getting out, and you're either shorting or you're just exiting that $5,000. So there's the only time that you're going to lose that full $5,000 is if the stock goes to zero. And that's something else to consider, so that you don't want to put your entire account in that. You'd want to allot a specific percentage. So that's what I will do with that type of trade. And I can take multiple trades on different stocks that are doing that type of a strategy, where I have 5,000 here, 5,000 there, 5,000 there, 5,000 there, 5,000 there. But just as you pointed out, you still need to understand how you can hedge your gains. And there's still an exit strategy. I know when I'm going to be exiting those trades. I'm not just going to be throwing money every which way and not understand how I can exit or protect those gains. So that's really what's important, right? But that's
I would also say too, the ability to wait and hold, and that's fine. Like, I love cash flow, right? So even in the sense of like having multiple companies, and if you just have one account, it's an IRA, and like I said, SPY drops 90%. Yeah, if it goes to zero, who cares about your retirement, right? I mean,
we have bigger problems.
It's not there, right? So something like that is a solid something to do it with. But I like cash flow too. So even if you have $20,000 in the account, break it to 3 companies, break it to 5 companies, whatever it is. Because as one company that you're like, man, this is really cheap, I'm going to hold it. All right. The question is how long. Your assumption is I'm okay with 6 months. What if it takes 6 years, right? What if it just never moves? And now what are you going to do? I still have a great price on this thing, and I'm not making any money out, right? But if I have 3 companies, if I have 5 companies I'm doing it with, all right, well, this one, which I expected to bounce sooner, all right, maybe the other one's working in between. I get to sell out, I get the cash, I get to reinvest it. Now I'm making ROI on the money that I made. And your money's kind of moving into different assets, different classes, and that one perfect trade, that one company, that one ETF, whatever it is, that was supposed to move, that's not doing anything, that gives you more time to hold and wait, and you don't feel like you're missing out on every other opportunity in the world too. So find out what kind of trader, find out really what's important to you. Is this, do you have all your money into the stock market? Is everything you have in here? How are you making money while you're trying to hold this thing? Keep all that into mind, because that's going to come into play of like how you should really develop your plan for the buy, hold, pyramid type setup, swings, things like that as well. Yeah,
for sure. Now, what are tools that you use to calculate position? So, do you get a calculator and you do that in your head every time, or like, do you have a favorite tool that you use? What do you do?
Tracy, I'm like Rain Man. I just look at the stock market. I just know.
You just know?
I just know. No, I do know how to put my entry and my stop into my Excel spreadsheet. That's about it. So
that's a cool
you
tool.
Just build out that formula. For me, I have on my Excel spreadsheet 5 different lines that I have, and this way I could put in multiple prices, get good risk rewards, see where the targets would be, things like that. I could leave them up there until the prices start to get there. But yeah, for me, the Excel spreadsheet works great. I just put my entry, my stop in. I know on TradingView there's a tool that will do it for you.
It's my favorite tool.
But I live really close to the Amish people, so I'm one of those. Paper and pen would be perfect, but stick with what you know. Right?
I actually thought you were part of the Ghostbusters team, because most of the time today, anyway, I'm just seeing your head floating around. So I'm pretty sure the audience is going to get used to you just floating around with your head because you're disappearing.
This light, by the way, that's a good point. The light, I'm not this white. I promise, I'm not this white. And I was like, as I'm moving around, I'm like, I'm really white. I'm disappearing half the time. Just floating head. But.
No, I use the spreadsheet as well. I use a spreadsheet. I use my own spreadsheet, but I also use the TradingView tool, because I think it is one of the best tools. The TradingView tool is by far my favorite for position sizing. So I use that regularly. Love it. And so that's pretty much where I'm at. But listen, we are going to raffle off another session with Dan and myself. So this is how you can get entered in for a coaching session live on our Pivot podcast. What we need you to do is like and share these videos, throw a comment below, throw a question in there, talk about position sizing. You can ask us a question about something different, but throw that in there. And I'm thinking probably the first week of April. That's when this episode's going to come out. We'll do the draw at the end of April. So throw some comments in there. We are going to start to hold, or we'll start accumulating who's entering those comments. And in the comment, if you want to be entered into the draw, please throw that, put hashtag draw into the comment. That way we know you can be added into the draw. If not, you're just putting the comment and you don't want to be part of the draw, then that's cool too. So do that, and then be prepared to be on the show, and we'll do a live coaching session with Dan and myself the first week of May. So that's what we'll plan to do. So do that.
Just so you guys know too. So Chuck in the chat pane says, I never win anything. So for everybody else that's not Chuck, your odds just increased a little bit, right? So everybody else but Chuck has a really good shot at this. But you got to be in it to win it, Chuck. We'll see. We'll see what happens.
Absolutely. And somebody just asked, how do you use the volume profile with position trading? Pound draw. You got to throw that. Yeah, we'll add your name. Actually, you know what, Matthew? You need to send that question to either Dan or myself in the DM so that we can keep it, because the minute we shut this down, all of your entries will be lost in that chat, and I won't have time to get it. All right. But no, great question. And we will address some of those questions as well in the episode. At some point, we'll be addressing those questions later on down the road when we do more episodes. So Dan, once again, we're out of time, and that's pretty much where we're at. So
I can't believe it, but we do appreciate you guys joining us each and every week for the Real Life Trading Pivot Podcast. Tracy, always a pleasure to have you co-hosting with me. All you guys that hung around in the chat, love you guys for hanging out, and for all you guys that got to catch us on the video, thank you for tuning in each and every week, and we'll see you next episode. Take it easy, guys.
Later.